Now, if you're an individual investor or you have, maybe a partner or two, and you guys own a lot of properties, then even in the case where you're holding a property for a short period of time, it still may make sense, because if the plan is to continue to buy more properties, you may have losses from one to offset the gains from another on the sale. And so you can continue kind of deferring this and keeping the ball rolling.
Welcome to the Multifamily Wealth Podcast. I'm your host, Axel Ragnarsson, and on this show, I dissect how seasoned multifamily investors started, built, and scaled their businesses. What's going on, everybody? Welcome back to the Multifamily Wealth Podcast. Joining me this week is Yonah Weiss, who is one of the foremost experts on cost segregation and the power of using cost segregation to minimize your tax liability as a real estate investor. And in this episode, we define what cost segregation is. We talk about what accelerated depreciation and bonus depreciation is. And we talk about the power of being classified as a real estate professional. And this is going to be a great episode for those of you that aren't familiar with these concepts and don't know what I'm talking about right now, because I'm sure we're going to blow your mind as it relates to the power behind using cost segregation, bonus depreciation, and your status as a real estate professional to effectively wipe out your tax liability at the end of any calendar year. So this is a great episode for those of you that aren't currently using these strategies. And for those of you that are, or vaguely familiar with cost segregation and bonus depreciation, you should still give this episode a listen to hone your understanding, because I throw some real life scenarios at Yonah and ask him how he would approach them and the advice that he would give people in those situations. So this episode is all about saving money on your taxes, which obviously we all love to do. That's why we're investing in real estate in the first place. And through using cost segregation studies and taking bonus depreciation, you can effectively wipe out your tax liability as a real estate investor and as a real estate professional. And obviously, this is going to be an important episode to go speak with your CPA afterwards. I'm not a CPA. Yonah's not a CPA. Those are not our roles in the business. So none of what we talk about in this episode is tax advice. You need to go to your tax professional, your CPA, to discuss how you can implement these different strategies we're talking about. But this episode is just filled with very, very actionable and important content that all real estate investors need to understand and need to be exposed to. So I'm sure you'll gain a ton of value as you listen to this episode. And if you haven't already, please leave the podcast a rating and review, as it helps this content get in front of more people. But without further ado, let's get to this week's episode with Yonah Weiss. What's going on, everybody? Welcome back to the Multifamily Wealth Podcast. Joining me for the second time is Mr. Yonah Weiss, who is known as the Cost Seg King. I think that is that might be your official title, at least on LinkedIn. But probably the foremost expert as it relates to cost segregation, accelerated depreciation, all of these fun topics that we're going to be getting into today. But an invaluable guest, an invaluable source of information on this topic. So as I mentioned, Yonah, you were on the show a few years back. Some things have changed as it relates to some of the legislation around, how the IRS looks at bonus depreciation, what they'll allow, et cetera. So bringing you back for a bit of an update, but we'll also talk about the fundamentals of cost segregation too. So why don't we start with your story? Maybe share what you do, how'd you get into this racket, and what's your business look like today?
Well, first of all, Axel, really great to be back on the show. So grateful to you for having me, and grateful to have you as a friend in the network. And cost segregation is it's been something I've always wanted to do since I was a wee little kid. And no, honestly, I was a teacher for many years. My passion has always been about helping people, and teaching was just an easy way, something that I started off young. I think like in junior high school, I first started off as like a tutor and just loved it. And then ended up continuing to do that as years went on in different capacities. But at a certain point, about 8 years ago, at this point, I had a lot, financial struggles, and had like a health crisis in my family, which gave me pause and allowed me to really realize, okay, what am I doing right now? I need to make some changes. And that led me to just search out some changes, some new opportunities. And real estate came up in conversation with a lot of people that I reached out to. So I ended up starting, doing various things in the real estate world. I learned commercial mortgages first, just from a friend, learning from him, who was a very successful commercial mortgage broker for many years. And then I ended up being a real estate broker for a little while, trying to find off-market deals, did a few fix and flips, and wasn't so fulfilled with any of that until I, was introduced to this company, Madison, what I currently work for, now going on almost 6 years. And they are the biggest national cost segregation company. I was really open for an opportunity. I wanted to stay in the real estate world. I liked the networking. I liked the, just the people I was around. And this company happened to be, it was just a great introduction. And from there, I learned very quickly that nobody who I spoke with in the real estate world knew anything about cost segregation.
Yeah.
So I was like, okay, I'm not alone that this is some like new topic to me, but I quickly used my teaching skills and abilities to just share the knowledge and share the message with this, like I said, very underutilized tax strategy that, over the last 5 years or so, I think has taken off quite a bit, especially because of the bonus depreciation laws that came about, and just keep doing it. Through that, I've opened up the network. Obviously started my own podcast, as you mentioned, and having just a great network. I've invested on my own as well in syndications and in real estate deals, and it's just allowed me to really be a part of the greater kind of real estate community.
Absolutely. And, your background as a teacher obviously connects a lot of dots, because I think you do a great job at communicating what can be a pretty complex topic in a simplified way. I think, and it's interesting to me too, how many folks are in real estate at an advanced level, and they don't have like a good grasp of this concept. And I'm sure obviously you're dealing with that on a daily basis, right? Because that's the world you live in.
Right.
But our goal today is going to be to demystify it a little bit and share some of that information. And glad you plugged the podcast, and I'm sure you will at the end of the show too. But Weiss Advice is a great listen for all of the listeners of this show. Go check it out, and I'll plug it again towards the end. But let's just start with the high level, and then we'll narrow down into maybe some of the more nitty gritty tactical components of cost segregation. But we'll start with defining it. Maybe we define cost segregation, and then we can begin defining accelerated depreciation and bonus depreciation and those concepts.
Right. Cost segregation, it's a weird kind of name, but if you think about it like this: cost, you have a purchase price, the cost of a property, and segregation, and we're breaking it down into its components. And what we're talking about here is depreciation. So really we need to take a step back to understand this tax deduction called depreciation. That's all cost segregation is. It's an advanced form of depreciation. Whenever you buy a commercial or residential property, besides for your primary residence, the IRS allows you to take an income tax deduction called depreciation. I emphasize the word called because it's not intrinsic to the property, and it's actually a borrowed term. It doesn't mean that your property is going down in value, which you think appreciation is going up in value, depreciation is going down in value, but really it's a borrowed term. It's a tax deduction you're allowed to take as if the property was actually going down in value. And it starts over every time there is a change of ownership. So again, it's not intrinsic to the property. It's totally subjective to the owner. Now, the traditional way of depreciating a property, what they call straight line depreciation, is over a 27.5-year period for residential properties and 39-year period for commercial properties. Meaning, let's say buy $1 million property, you take off land does not depreciate, you take off a small amount for that, and then the remaining amount you divide by 27.5, and you're able to take a tax deduction of that amount every single year. So $1 million property, approximately $30,000 tax deduction, which you can then lower your taxable income. So if you made, let's say $50,000 income on your property over the year, you can reduce that by $30,000, and you're only left paying taxes on the remaining $20,000. That's the simple definition of depreciation. Now, cost segregation, as I said, is just breaking down that cost or segregating that cost into different components. And believe it or not, cost segregation used to be called, more accurately, component depreciation, which means we're taking certain components like furniture or fixtures or window treatments, right? Carpeting, cabinets, countertops, all that stuff. The IRS actually says depreciates on a 5-year schedule, not a 27.5-year. So we, through an engineering approach of identifying those components within the property, assign a value to all those individual components. And then you can take a tax deduction or a tax write-off for that greater amount, sometimes 20 or 30% of the property value can actually go into these faster categories. and allows you to take bigger tax deductions in the earlier years of ownership.
No, great description. And the benefit here, right? Correct me if I'm wrong, is obviously time value of money, right? You want to pay less in taxes today because money is worth more today than it is in 3 years, 5 years, 10 years, what have you, right? And that's typically the motivation. Now, we were throwing around a couple of other terms. We were talking about bonus depreciation as well, which is a component of cost segregation, but maybe can you define bonus depreciation and talk about how that is an even more supercharged version of this strategy?
Right. So once you've done a cost segregation study and you've identified what those components that depreciate faster, like I said, the 5-year category is one, there's another category that's 7, another 15-year category. These are land improvements, for example. Once you've identified what those things are, and again, it can be 20 or 30% of the total property, you have the option to take 100% of those deductions in the first year. Okay. And so that's what's called 100% bonus depreciation. This was a law that came into being. It was an old law, but it's had various changes or various kind of models of what the law consisted of over the years. But in 2017, the Tax Cuts and Jobs Act introduced this 100% bonus depreciation that said you can now take this full amount of 100%, all the accelerated depreciation components, you can take as a first-year tax write-off. So instead of taking more deductions in the earlier years, like you said, the time value of money, using more deductions, you actually get to front load a huge amount of those deductions into the first year. Now, there's actually been some changes, not changes really, but when that law was introduced, it was only set to be in play through 2022, meaning if you bought a property between the end of 2017, some random date in like September 28th, 2017. I think it was like the day that Donald Trump bought a building. So like that was the day they started. I think that's just my theory. I'm not sure. But until through the end of 2022, if you bought a property during that time, you can utilize 100% bonus depreciation, meaning you can take those full deductions in the first year. If you buy a property in 2023, right, this year, it's gone down to 80% bonus. I mean, you can only take 80% of those deductions in the first year. The remaining 20% can still be spread over those faster cost segregation lifespans. And it's going to continue to phase out by 20% each year until it's totally gone. And there will only be cost segregation remaining without that, kind of boost of bonus depreciation.
Gotcha. And I know you're not a politician, but I'm curious, as someone who's only been in this business during the time that this legislation has existed, right? Where you can take 100%, I got into this in 2016, right? But I didn't know anything about this until 2017, 18, 19. And 100% bonus depreciation has always been available. And obviously now, as you mentioned, we're starting to phase out of it. It's, as years pass, we're going to be losing 20% from what you can take in year one. Is there any indication that that's something that will come back? Is there historical precedent before 2017 when this was enacted, where there was legislation around this in the past, but maybe not as beneficial to real estate owners? Is there any sense in the community in that respect? And I'm sorry, question's a little bit convoluted, but I guess we're trying to figure out if this is something that's going away forever, or if there's always going to be some version of bonus depreciation available to real estate investors.
I'm not a psychic and certainly not a politician, but I can say that, as I mentioned, it has had various forms over the years. For the past 20 years or so, there's been some various form of bonus depreciation. Before 2017, it only applied to new construction, for example. It was only up to 50% of the costs for those accelerated components. So it had that form. Prior to that, it was, in a different form. So I do think that there will still be some form of bonus depreciation going forward, even as this phases out. I think it was introduced as a way to help inject, more cash into the economy, which it did. It certainly did. I mean, obviously, COVID had a huge wrench that was thrown into that plan, but I think it really helped because obviously real estate is not in a bubble in itself. It really affects so many parts of the whole economy. I mean, you talk about commercial real estate, office and retail, industrial. There's so many components to real estate. So I do think that it will come back in some form or another. I actually have heard some local representatives and things like that speaking about advocating for and lobbying for it being reintroduced, being brought back to 100%. So if there is any sort of change in the White House in 2024, that this may come back up sooner than we thought.
Yeah, exactly. And I'm putting you on the spot because you don't have the crystal ball, right? We don't know what's going to happen in a few years when this truly phases out, et cetera, et cetera. But it's good to understand that there's been language around this for a long time, and it'll exist in some form, most likely into the future, right? Which I think is, fundamentally the objective that I was getting at there, in terms of asking you that. Now, in terms of who this makes sense for, right? This is the Multifamily Wealth Podcast. Everybody who's listening to this is predominantly, in multifamily. Maybe they own some other commercial assets, but likely the majority of what they do is multifamily. I think that there's a misconception that cost segregation studies only make sense if you're somebody who's buying large assets, however that's defined, 100+ unit buildings, these large high-rise properties, or just buildings that cost $10 million plus. I've personally done cost segregation studies on smaller buildings, but can you speak to whether it's a deal size from a dollar amount standpoint, a unit size standpoint, in terms of where it makes sense for an investor to explore getting an engineered study done on their property?
Absolutely. It has a lot to do with the dollar amount of the purchase price. Because as we mentioned, what we're doing with the cost segregation study is, basically breaking down the depreciation into, faster categories where you can get sometimes 20 or 30% of that purchase price as accelerated depreciation. Now, it's all a numbers game. Obviously, if the higher the value or the higher the purchase price of the property, the more tax benefits you'll get, because it's proportionate, a percentage of that purchase price. However, I totally understand why there has been a lot of misconceptions, I think, around this question for many, many years. It used to be extremely expensive to get a cost segregation study done. And it used to be only for, like you said, large commercial properties, $10 million buildings. And in fact, funny enough, there's this Journal of Accountancy article from like 2003, I think, like floating around the internet. And I've literally seen people copy and paste this article into their blog. Okay. And essentially quoting like almost word for word, if changing stuff around now, at least a dozen times, literally, from like different syndicators and things like that, literally using the same wording. And in it, it says this wording. I know this because I recognize the wording, and it says something along the lines of, cost segregation may only be beneficial for larger commercial properties because it could cost you, $20,000 to $30,000 to get this done. And so to me, that's may have been true 20 years ago, right? There were not a lot of cost segregation companies doing this. And it was really, that was how much it cost. And nowadays it's changed quite a bit. Obviously it can cost, even an engineering study can cost anywhere from, $3,000 to $6,000, $3,000 to $10,000, let's say that range. And so that's obviously much different than, $20,000 to $30,000, which means if you're buying a property, I always say any property purchased for over $200,000. That's kind of my new benchmark. I used to say over $500,000, but then I realized people coming to me like, "Hey, but this property for $350,000 is worth it." We'll run the numbers and see, okay, you can save like $70,000 on your taxes. Is that worth it to pay like $5,000? Yes, for a lot of people it is. And so I changed it, to about $200,000, because that's really where it starts making like 10x sense, like in terms of, okay, paying and in terms of the actual after-tax benefit of this getting done.
100%. And I think again, it's just a simple mathematical equation. It's like, what is the value of this depreciation worth to me? And then comparing that to the cost of doing the study. Right. Now, there are some downsides, right? I mean, and when I say downsides, I mean, at some point, somebody's getting paid, right? And obviously, when we sell a piece of real estate, we pay capital gains on the depreciation recapture. So it's not like at some point you are not paying for this depreciation you're taking along the way. Can you talk about that component of doing a cost seg study? Because in my opinion, it makes a little bit less sense if you're going to buy a deal, you're going to do it, maybe you do a cost seg. There's all kinds of nuance around everybody's individual tax situation. So there's an asterisk here, but like if you're going to sell the property in a year, you're taking the depreciation, but you're paying it right back. Would you agree that it makes sense for somebody to analyze their hold period and to try and think about that before jumping in and doing a study?
Absolutely. There's a lot of factors. In fact, as you mentioned earlier, the time value of money is probably the greatest benefit of using the cost segregation. You are able to use your own money and reinvest that if you're going to do that. Obviously, not just because of inflation does a dollar today worth more than 5 years from now or 3 years from now, just because of simple, what you can do with that, the compound interest you can create by reinvesting your own money instead of paying income tax on it. Now, I think not only the hold period, which you said, like having a property, doing a cost, like selling it within a year or two, is usually less beneficial because you're going to have that recapture tax on the sale that you're going to be subject to. Now, there are ways to further defer that recapture tax or, get around that by having more depreciation losses to offset that recapture tax. So there are factors that come into it, but I think another important factor to keep in mind is not only your whole period for this individual property, but what is your overall portfolio? Now, if you're an individual investor or you have, maybe a partner or two, and you guys own a lot of properties, then even in a case where you're holding a property for a short period of time, it still may make sense, because if the plan is to continue to buy more properties, you may have losses from one to offset the gains from another on the sale. And so you can continue kind of deferring this and keeping the ball rolling. However, if you're in a syndication or you're a passive investor, obviously you don't have a say of what the general partners do. But it's important to ask and see if this is, that may be a factor. If they're planning on getting a cost segregation study done and also planning on selling it within a year or two, it may come back to bite you.
100%. Yeah. And, I think the challenge in having these conversations through this medium is there's all kind of individual nuance for everybody's individual situation. So it's, go speak with your CPA and have a holistic conversation around the strategy and how doing a cost segregation study fits in. But in general, right, I think the very broad statement is, if you're going to hold a property for a shorter period of time, you need to spend a little bit more time thinking about whether or not it makes sense, versus if you're like, I'm going to buy and hold this for 5-10 years, in which case it almost always makes sense, right? And that's, there's a spectrum there, right, to analyze. So with that being said, I want to talk about real estate professional status, because I think that's where you really start to see the benefits of doing these studies in terms of starting to deduct, or basically you can use the depreciation to offset a lot of gains, right, that are maybe passive or not passive. So maybe we start with, defining what a real estate professional is and talking about how this bonus depreciation, or the extra depreciation, I should say, that results from doing a cost segregation study on a property can help you if you are a real estate professional.
Right, exactly. And I was waiting for you to ask this, because more important than, if it's beneficial, the property size or the amount of the property or the potential tax benefits, et cetera. More important than that is who owns the property. And this is exactly what the real estate professional status is all about, is if you, and this is just to kind of clarify before we jump into this, this is an IRS definition, okay? You are called a real estate professional if you fill certain, it's
like requirements, right?
Requirements, yeah, exactly. Requirements. And so one of them is that you are full-time in the real estate trader business, right? What does that mean? You're materially participating in the ownership, right? Acquisitions, renovations, even brokering, but managing, operating, anything having to do with rental property, essentially. Now, it gets a little tricky when you're dealing with people who may be in the real estate business but don't actually own real estate. For example, if you work as a W-2 for a property management company, for example, and you don't own a portion of that, even though your whole day is in real estate, you're not considered a real estate professional by the IRS, because there's specific definitions. And that's one of them, deal participation of real estate that you own. Now, the second qualification is that you need to spend a minimum of 750 hours a year, which means you can't just relax and, don't do any work whatsoever or kind of manage the manager all the time. You actually have to spend some time doing it. Now, this is true if either you or your spouse qualify for this. So only one of you needs to meet this qualification of real estate professional, and then you get this designation. And why is this so important? Now we're getting to the, to the meat and potatoes here. Why is this so important, Axel? What is this about this real estate professional status, or REPS, REPS? You may see this if you're on Bigger Pockets, it gets talked about a lot, is you're able to use the depreciation deductions to offset your active income. Okay. Now let me take a step back and just explain that depreciation is considered what's called a passive deduction, and is your rental property income, or even take a further step back, right? Rental property income, real estate income, is treated differently than other sources of income. Okay. It's on your Schedule E on your tax return. It's called passive income, even though it's not really passive, but it's called passive income. And depreciation can generally only be used to offset your passive income. Okay, so if you have a W-2 or you have a 1099 or whatever, and you also have rental property, well, getting a cost segregation study done may not be that beneficial if you don't have so much income being produced from your rental properties. Now, you may, and therefore it may be beneficial. But if you're a real estate professional, if you or your spouse are a real estate professional, you get to use these extra deductions to offset your active income, ordinary income, whatever source of income you have. And therefore, that's why cost seg is really a huge game changer for real estate professionals.
Yeah, and I'm going to ask a couple of pretty pointed questions as it relates to, putting myself in the shoes of someone who might be listening. But this is where this really starts to get pretty wild. I think this is like, if you're listening to this and you're a broker or a full-time investor, a house flipper or a wholesaler, or, you're somebody that is, you earn your living participating in real estate, not in a W-2 capacity, as you just talked about, because that's a bit of a different animal, but you're earning your income based on materially participating in real estate related activities, and you fit this qualification. There's an entire world that you should be entering if you are not currently buying property, running cost segregation studies, because it completely changes your whole tax profile. Now, let's say we got a real estate broker listening, right? You mentioned active income, and I think it'll help to kind of define that as with an example. So we got a real estate agent, real estate broker, what have you. They sell single family, multifamily, doesn't even matter. They make a couple $100,000 a year in commissions. Mm-hmm. And they don't have, they don't own any rental property. They don't do any of this stuff. Yes, they are a real estate professional. That is, we've defined that they are a real estate professional. Talk about what they might be able to do in order to access what you're talking about. Buy a property, cost seg, and then can they take that bonus depreciation and deduct what they are paying against their earned commissions? Because I think a real life example is going to help people really understand what we're talking about.
That's exactly right. And probably the best example, like you mentioned, is a real estate agent or broker, or someone who is a fix and flipper, right? You are basically doing real estate fixing and flipping full time. But guess what? Those types of income are taxed the highest rate possible, meaning you're going to be paying a lot. So I always recommend anyone who is in the real estate business already should own at least one rental property and buy a new property every single year, if you can, to use this cost segregation. Because if you don't, there's nothing you can do. You cannot use cost segregation if you don't actually own rental properties. Because again, one of the criteria or qualifications is you are materially participating in rental property, which means you need to own something and manage it or do something. So again, even one property that you're holding, if you're doing fix and flips, at least hold one of them and rent it out. And then you can do a cost seg on that property and use that to offset your other income as well.
Mm-hmm, absolutely. Now, on the other side, let's say that we have somebody who's listening that is the W-2 employee. They're not a real estate professional, right? Maybe they're not even, they're a doctor, right? They're not even related. They're not even close, right? There's a very clear distinction here.
Sure.
And they have no desire to become a real estate professional. They didn't get lucky enough to marry one. It's funny because I know a couple of friends of mine that are getting married, and they're like, yeah, my sales pitch to my fiance was, this is the greatest wealth hack that you can have. That's why you should be marrying me, which is a whole funny side conversation. But let's say, they're in an industry outside of real estate. They own some rental property, and now they're passively investing in a syndication, for example. Can they take these passive losses, right, that results from investing either in a deal or in a syndication, what have you, where they have all of these paper losses that are result from this bonus depreciation? Can they use that to offset capital gains if they were to go and sell a rental property? Is that considered a passive gain? Or I should say, it's technically a capital gain in terms of how it's taxed. But in that situation, can depreciation losses be used to offset capital gains for somebody who's in that position?
They can. And so that's a really good point. The capital gain on the sale of real estate, and I want to make a big distinction, because capital gain on the sale of stocks or crypto or any other thing like that is treated differently, portfolio gains, et cetera, differently than your real estate. And that's considered, like you said, Axel, passive gains. Passive losses from depreciation, even though you can't use it against your W-2 income, your high, doctor, whatever income, you can use those losses to offset the gains from the sale of another rental property. So it's not all lost when doing a cost seg. So again, it may be beneficial, even though you're not going to be using it to offset your W-2 income per se, but it's going to help to offset any rental income you have and any passive gains you have.
Got it. Perfect. Now, in terms of actually tactically executing a cost seg study, so, let's say somebody hears this, they just bought a property, they're like, perfect, I want to do this, right? They go and they email Yonah and they say, hey, I want to get a cost segregation study done. What does that process actually look like? Maybe from a timeline standpoint, how does the study get done? Is it virtual? Is it in person? And I'll stop there because I'll have a couple follow-ups, but I don't want to overload you. So
Sure.
in terms of what that process looks like for somebody who's looking to get one done.
Pretty simple process. First step, obviously, reach out to me or someone like me who does cost segregations full time. We always like to run a free upfront analysis so you can see ahead of time what the potential tax savings are versus using the straight line depreciation method. So you can already know what you're getting into before committing. Then the process is, like I mentioned, it's an engineering study of the property. So we need to send one of our engineers either physically, or we do a lot of them virtually, which means just having like a video call with someone who can walk through the property with our engineer on the other line, and basically capturing video, pictures. We collect certain documents, appraisal, et cetera, from you and create a detailed report or a cost segregation study. In that report is, it's about 80, 90, 100 pages long. And in that breaks down into detail, in great detail, every tiny little component of the property and what its cost, what its value is, and also various calculations to determine what the depreciation value is, that and how we can accelerate that, creating a new depreciation schedule. Okay, so that's a pretty simple process. It's about, we take about 6 weeks or so to turn around one of these things. And it can be done, like I said, anywhere in the country, because obviously, especially now that we're doing it more virtually, it can be done anywhere at all.
Gotcha. Makes total sense. And in terms of like the timeline around this, so, obviously, I think we're conceptually thinking about this, like we're buying a property, let's do a cost segregation study. Can somebody do one on a property they've owned for multiple years? When does it make sense to bring an engineer, like Madison into the equation? And then the last question I have, because this is maybe a little bit more nuanced. A lot of people listening, they buy properties, they fix them up. They implement some kind of value add, they push the NOI. Does it make sense to have a study done before tearing the property apart and fixing it up? After? Is there implication there? So I guess a few more questions that I told you I wouldn't bombard you, and I guess I did.
No, it's fine. You can't possibly ask me too many questions. It's the more the merrier. But I'll try to break them down one by one. The first point is in terms of when to get it done. Cost segregation can be done at any point in time. And the question of when should it be done is very subjective, because the best time to get a cost segregation done is in the year when you can benefit from those tax deductions the most. And yes, most people like to get it done in the first year of ownership. Obviously, you want to set up your taxes the right way from the beginning. It makes a lot of sense. But in many cases, it actually, is not going to be beneficial to get it done if you're not producing enough income, or maybe you're in a lower tax bracket, this year when you're buying this property, and next year you'll be in a higher tax bracket. And so the after-tax benefits will be greater. The good news is it can be done at any point without having to amend previous year's taxes. So if you own a property for 5 years and we're just using straight line depreciation method, we can go back and do the cost segregation on that property. And this year going forward, essentially catch up whatever depreciation you missed. And you can take it this year. And that's really important when it comes to the bonus depreciation as well, because you can still get 100% bonus depreciation this year in 2023 for a property you bought in 2022 or previous years. Again, it goes on when you bought the property and not on the year you're doing the taxes. Okay. And so that's a really important point a lot of people don't know. Now, in terms of the renovations or the value add or the upgrades you're doing, it's a nuanced question because it really does depend on the amount of renovations that are being done, not only as a dollar value, but also on the extent of what the renovations are. Now, best case scenario, it's usually best to get the cost segregation done before you start renovations, so you can capture the property and the depreciation and the property as is, and we can essentially assign a value to all the components. Now, when you go and tear things out and replace things and do renovations and add more money into the property, you can now also depreciate those capital expenses. All the money that went into the renovation, you can now depreciate those costs as well. So you may want to get an updated cost segregation study done on the renovations. We call that a renovation study. And that allows you to capture and accelerate the depreciation of all the money you're putting back into the property. Otherwise, like I said, there are cases where it may make sense to do it only before or only after, or before and after. And so it is a little bit nuanced, again, based on the extent of the renovations as well as the dollar value being put in.
Absolutely. No, that makes a lot of sense. I think we touched on everything that I really wanted to get to. Is there anything I should have asked you that I didn't, or anything that that we didn't touch on that we should have touched on?
There are a lot of questions surrounding cost segregation. You definitely hit on most of them. You had practice because we did this once before a few years ago, right?
Yeah.
No, but seriously, it's I think one important, and probably the most important thing when considering cost segregation or hearing about this is making sure that your accountant or whoever's doing your taxes is on board with this and understands this and can apply it, because that's probably one of the most common things that I hear is, how come my accountant didn't tell me about this? Or my accountant says that I can't do a cost segregation, or yada, yada, yada. There's, a ton of things that I hear from people regarding their accountants. And mostly the common denominator is that the accountants are just not real estate savvy and don't understand or don't know enough about this, even though it's in the tax code. This is not some, just to clarify, this is not like some kind of rogue, tax deduction that's really kind of shady and, who's doing this. No, this is directly from the IRS. This is in the tax code. It just happens to be that the tax code is massive. And unless you specialize in real estate, this just may not be something you are familiar with.
That's a really good point, actually. And I should have brought that up because it's funny, just quick story. I was speaking with a hard money lender recently who was looking to invest in one of our deals. He full-time lends money. He's a retired real estate investor. And then he started lending money. A full-time real estate investor for 40 years, mind you, right? Same accountant for that whole period of time. And, I was telling him, I said, you should speak with your accountant. There's probably some value here in being able to deduct some of the bonus depreciation from passively investing in our deals against maybe some of the interest income, or maybe against some of the income that you're still generating from like the 2 little rentals you still have. And it was a completely foreign concept. And he'd been an investor for 40 years. And he was like, I cannot believe I'm just finding out about this now. And I think that happens quite a bit. And you're right. There's just a lot of accountants that either aren't aware of it. But this specific gentleman, he said that his accountant said that it was too risky. And that was where he left it. And that's just, there's got to be a little bit more analysis, I think, around that topic if you're somebody's accountant or CPA. But I think that that is a good point. Madison SPECS cost segregation firms. I mean, I'm sure there are some CPA firms that have an integrated cost segregation arm or something along those lines. But
for sure,
but these are two separate entities, right? You have your CPA, and then you have your, cost seg engineer or cost seg company that is acting as a vendor and providing you with the report to go, bring over to your CPA. And it's important to make that distinction. So I'm glad you brought that up because it's a bit of a nuanced thing. So. Listen, Yonah, this has been great. Appreciate your time. I think everybody who's listening that isn't familiar with this concept is going to be running to get in touch with you or to speak with their CPA or to do something. But if folks do want to get in touch with you, if they want to learn more about what you're doing, how can they reach out?
You can find me on all the socials. I'm most active probably on LinkedIn and Twitter at this point, but Instagram, all the places. Or you can go to yonahweiss.com and just find me there, shoot me a message. If you do find me in the socials, don't just follow me, but shoot me a little message also.
Absolutely. And let them know that you heard him on the Multifamily Wealth podcast. So I get some benefit out of this.
You betcha.
It makes me look a little better. But thanks again for your time. This is great. Appreciate all the value you bring to the community. And for everybody listening, go follow Yonah on all the socials because he is probably the most active individual that I know on all of these different platforms and is constantly bringing value. So thanks again for your time. Thank you for listening to this episode on the Multifamily Wealth Podcast. If you learned something new during the show, please consider sharing this episode with a friend, family member, or business partner, or just leaving a rating and review as it helps the show get noticed by more folks. Catch you next week.